We are back on Closing Bell. Tesla leading the Mag 7 this month, and one top analyst doubling down on the name. Let's bring in Wedbush Global Head of Technology Research, Dan Ives. Dan, you are getting even more bullish on Tesla. Tell us why.
I mean, look, I think this is now going to be the start of probably the most important chapter of growth ever for Tesla. In terms of autonomous, I believe we're going to see 30 cities, potentially over the next 3 to 6 months, and that's going to be the start. Because, Courtney, my view is that they will own 80% of the autonomous market, and that is not being factored into the stock. I mean, that's why I think this is $2 trillion for starters. Ultimately, will be a $3 trillion market cap. This continues to be, in my opinion, the most undervalued true AI play in terms of physical AI play out there.
But how long is it going to take them to get to that type of market share in autonomous?
Oh, I think as we go into later this year, and I think especially once we go through the shareholder meeting, when Musk gets pay package and ultimately Tesla gets approved for the XAI investment, I think investors are going to start to realize when this gets rolled out to another 8 to 10 cities over the next few months, and you start to see the scale of ultimately cyber cabs, I think that's where the bell goes off. I think investors right now, there's still skepticism because of the core business, which is actually stabilizing. We'll see that next week. But I think this is all about autonomous and robotics. I think this, along with NVIDIA, the two best physical AI plays in the market. And Musk now is back to wartime CEO. And that's what you need in terms of this AI arms race.
Wow. And so your target is going from 500 to 600. And I think the average analyst estimate is somewhere around $342. And you think that is all because of autonomous?
Well, yeah, because I think when you look out, when you think golden goose for AI, it's autonomous and ultimately it's robotics. And that's going to be Optimus. And I think Tesla right now is on the verge of what I think is going to be a period of hypergrowth. And I think that's something that's not being factored in, is a lot of investors just continue to paint it with the same brush. And all the work we're doing is showing that this is an acceleration that's about to happen. That's why we raised price target, continues to be one of our top picks in this fourth industrial revolution.
Do you think that there's still some political backlash with those that didn't agree with Elon Musk or don't agree with Elon Musk and his association with the Trump administration, whether they're enemies, friends, frenemies? I don't know where they are right now, but how does that play out into demand for the vehicles themselves?
Yeah, I think you almost have to separate. I think, look, in Europe, there's clearly still brand damage, and we see that in terms of the numbers. But I think some of that is going to fade, over time, as well as in the U.S. Look, there still could be, like we said, 5-7% permanent brand damage. But I think the broader view here is that they're really going to own what I view as the autonomous world, the autonomous market. And you talk about with Trump and the BFF to the enemy and back now. I think it's all about regulatory. I think Trump administration is going to accelerate the federal roadmap in terms of what's going to be bullish for autonomous. And that's going to be, very important in terms of laying the groundwork for what I believe is going to be acceleration of this autonomous strategy. And I think that is how Tesla is going to be viewed. This is not just for Tesla, but for Musk, most important chapter of growth in its history.
Yeah, I can see how that certainly would help fast track Tesla if that goes as you think it will go. But, you never know with this administration or the way that they view past friendships or forward looking friendships. Good luck to Penn State. Big game tomorrow.
We are. Big one tomorrow.
Thank you, Dan Ives.
Thank you.
Well, coming up, shares of Boeing soaring in today's session. We'll tell you what has that stock moving higher when Closing Bell returns.
Why do you think you've been able to
Coming up next, President Trump slapping new tariffs on key parts of the retail space. We're breaking down the fallout ahead. Closing bell. We'll be right back.
Com.
We're getting more breaking news out of Washington. Eamon Javers has that for us. Hi, Eamon.
Courtney, the Department of Justice has just made a new filing in the ongoing Supreme Court battle over the president's effort to fire Lisa Cook from the Federal Reserve Board of Governors. Here's what the president's side is arguing here in this ongoing case. They say by authorizing the president to remove Federal Reserve governors for cause, Congress required the president to provide a cause, something more than a mere policy disagreement. But Congress otherwise respected the president's constitutional authority over principal officers of the United States by declining to limit him to specific causes or specific removal procedures. So what the president's side is arguing here is that, yes, they need to have a cause, but it can be pretty broad range of causes that the president can use here. They say the president acted entirely appropriately. They say, furthermore, that Lisa Cook, despite this allegation of mortgage fraud hanging out there for weeks and weeks now, has not really defended herself on the merits. They say Cook has still not attempted to deny, explain, or justify the facially contradictory material representations in two mortgage agreements that she executed just 2 weeks apart. There's another point in here that I want to bring up, Courtney, because this is directly at financial markets. They're arguing here, the Lisa Cook side argued that any effort to remove her shakes Fed independence and could rattle global financial markets. The Department of Justice, on behalf of the president, now arguing the opposite. They say it's not apparent why financial markets would be spooked by removals for pre-confirmation but not in-office financial misconduct, or why they would derive comfort from the prospect that newly detected fraudsters could serve on the Federal Reserve Board so long as the statute of limitations has run. So the president's side here, Courtney, arguing that, in fact, it's maybe worse for markets if somebody is detected to have committed fraud and be allowed to stay on the Federal Reserve Board. That's the argument just filed by the president's team.
Okay, got it, Eamon. So the saga continues. Thank you so much for the latest. Retailers coming under pressure today after President Trump announced a 50% tariff on imported kitchen cabinets and bathroom vanities and a 30% tariff on imported furniture. Joining me now to discuss the potential fallout, Evercore ISI's Greg Mellick. Greg, thank you so much for being here with us. I know that you cover Home Depot, and that was one of the names that came to mind for me as soon as I saw some of these headlines. What do you think the impact will be?
You know, we think for the retailers, especially one like Home Depot, they have a big, broad enough global supply base. And in the case of Home Depot, the majority of what they're doing, they're sourcing here in the U.S. already. We think it's pretty muted. If it's a big enough gap, you'll probably see some production move back to the U.S. And other areas, you'll find vendors that are able to find a way to take out some more cost to still, if it's more efficient to import it, then they will.
I mean, after the latest round of earnings reports, and we got a little bit more detail of at least some of the tariff impact starting to leak in through the company's businesses and the consumer's reaction, I've been really surprised, frankly, at how strong companies have been able to be when it comes to their mitigation strategies. And where there are price increases, consumers don't seem to be rebuffing. They are continuing to buy. Do you think that will continue as we see the full impact going into the back half of the year for your coverage? I mean, Christmas is coming and we still haven't seen the full impact of the tariffs.
It sure is. And frankly, we do think retail sales are going to decelerate from the 5% growth that we saw in August, or a really strong back to schools you described, to something with a 3 handle as we go towards holiday. So we do think we're entering a bit of an air pocket into the fourth quarter. And it's really going to be a function of some of the, what isn't mitigated is eventually does pass through. And we do think that puts a bit of pressure on consumer. What we don't know is whether consumers are going to spend less on retail goods, or could they take some spending out of other areas of consumption? So that'll be a key area as we watch into the fourth quarter. But we think it's a deceleration, not a disaster, if you think about holiday.
So you have a pretty wide range of coverage here, but you've got sort of the everything places like the Amazons and the Walmarts of the world, but then you also have the O'Reilly names. Which do you think are best positioned, both with their businesses and as well as the macroeconomic headwinds they may be facing going into the back half of the year?
I think that's a perfect question. And the key is to keep your eyes on the prize. And we look to say is play, but play it safe. Walmart is gaining share. They have plenty of new businesses and traffic growth that's allowing them in automation to basically eat some of the pressure of tariffs and still grow their margins. And we think make their numbers into year end. And I would say as you go to next year, keep an eye on Home Depot. That's a category that has underperformed for some time. The stock multiple has not been bid up. And, we think you could have some sort of a nice home improvement recovery next year. Remember, there is $125 billion of stimulus that we think will be even larger than the pressure of tariffs on consumers that'll be coming in the first quarter of next year. So once we get through this air pocket, we think you do need to play a little bit of offense. Home Depot to us is a good one. And on auto parts, that's a need-based category. And basically the price elasticity that we've seen from AutoZone just earlier this week is 0. So to the extent they have to raise price, the consumer is saying, you know what, that's better than paying more for a new car or even a used car. So I'll just fix up the one.
It's all fascinating, and as we look into the holiday season, I'm going to be really interested to see the interplay between promotions and tariffs and what ends up happening for the prices that consumers are willing to pay. Greg, we have to leave it there. We've got a busy day of news, but thank you for joining us today.
Thanks, Courtney. Have a great weekend.
Thanks, you too. Well, up next, we will tell you what has shares of Intel rallying again today. Closing bell. We'll be right back.
The sky.
We're back, and we're tracking another big move in Intel today. Let's get to Christina Partsinevelos with more. Hi, Christina.
Hi, Courtney. Well, Intel is up again today on reports the U.S. is considering new semiconductor tariffs. This is according to the Wall Street Journal. The proposed policy would impose a 100% tariff on imported chips that exceed what a fab produces domestically. So 1 for 1. If implemented, this really creates a lot of clear winners and losers. And what I mean by that, companies with existing U.S. footprints like Intel and Global Foundries, which is up 7% today, benefit competitively. Taiwan Semi is down about 1%, though large fabless players like NVIDIA, Broadcom, AMD, Marvell would likely redirect more orders to TSMC's U.S. facilities in Arizona. but execution is going to be tough. Most chips are imported, embedded into finished systems, so they're already in the servers and laptops. So system manufacturers like Dell or Supermicro would really have to track down semiconductor origins across their entire supply chain. That is not easy. Separately, also adding to Intel's share price, Intel CEO reportedly approached TSMC about a potential partnership, TSMC not commenting, but recent cash injections from Nvidia, SoftBank, the US government last month are really making investors view Intel as a government proxy, which could mean attracting even more partnerships from companies that are seeking White House favor. But the bottom line for chip companies right now, expanding US manufacturing capacity, or at least credibly promising to do so, is becoming the clear path forward under Trump's trade policy, Courtney.
Very fascinating, interesting story going on there with Intel. Christina, thank you. Well, coming up next, President Trump takes aim at Big Pharma. A top healthcare analyst is standing by with reaction. Closing bell. We'll be right back.
Why do you think
We are now in the closing bell market zone. CNBC senior markets commentator Mike Santoli is here to break down the crucial moments of the trading day. Plus, BMO Capital's Evan Siegerman on the fallout for Big Pharma following President Trump's latest wave of tariffs. And Phil LeBeau on what's behind Boeing's big breakout. We're going to start with you, Mike. I mean, obviously, it seems like the action started this morning with that PCE read, and markets felt pretty good about it going into the weekend.
Yeah, Court, definitely reassuring. Not necessarily a blowout, but incrementally a little bit better than expected on the spending and income side. PCE inflation's been hanging around these levels for a while, and the equity market's going to be fine with that as long as the bond market doesn't get overexcited about it, and so far it's not. So I think in general, you'd almost consider it a net win that the S&P's down only 0.33% this week. It's less than 1% off its highs, given that the setup was you had this pretty extended rally, some seasonal weakness coming in. And I would say around the margins this week, we got less certainty around the bulletproof nature of the AI trade and perhaps exactly how many Fed rate cuts we're going to get this year. But it was all enough within the bounds of expectations to keep the index on track in general, even if we're not out of the woods seasonally.
Fair enough. Mike, hang tight with us for a second. We are going to turn to BMO's Evan Siegerman for his reaction to President Trump's new tariffs on the pharma sector. Some pretty big numbers, but then Eamon Javers is telling us bilateral trade agreements will be honored, so maybe not as bad as feared. And it doesn't seem like the stocks themselves are really worried here either, Evan. Explain to us why.
Exactly. So it's a 100% tariff, but it doesn't apply if a pharmaceutical manufacturer is building or has broken ground in the United States. And literally every company I cover that sells drugs has manufacturing here. So I'm sure there's a carve out. And then, of course, there is, to your point, that 15% bilateral trade agreement, which would supersede any of this. So it's more, I think, bark than bite at this point. But when you look at what a potential tariff would be, is it on the API that's imported, on the cost of goods sold? I think the biggest issue is if there were a tariff on, say, a transfer price, which could hurt a name like Merck. But again, they have manufacturing in the United States, so all of this seems moot.
And what about sort of the materials? I mean, if the final good, the medication is made in the United States, what about what's brought in to actually make that? Where does that stand?
Sure, there could be a tariff on that, but that's such a small portion of the cost of a pharmaceutical product. I mean, the gross margin on these products are 85, 90+%. So that API component is maybe a percent or two, so 10, 15% on a percent of the overall cost isn't a ton. Again, we're not super worried. We're more focused on the IRA negotiated price list, which is coming up next month. And of course, any potential drug pricing negotiations pegging our prices to those prices outside of the United States.
Got it. That all makes sense. Where is sort of your thesis for the strongest names, knowing that we still have a lot of question marks to come here, as you point out?
For sure. So we still like Lilly, but it's not our top pick. We're really bullish on Gilead. We think that their long-acting PrEP launch is going well. We also highlight top, favorite names like Vertex, for example. Pfizer also, we love the deal that they did earlier this week. I feel like they're starting to get out of the doldrums that they have been in for the past year and change, but we do need to see execution there.
Okay. Fair enough. Evan, thank you so much. Appreciate you joining us here on this Friday afternoon. I want to move on and talk to Phil LeBeau. Phil, shares of Boeing. What's going on here on this one?
Well, a big move by the FAA to give partial certification authority back to Boeing. So this is what it means. They now will have the ability, which they had back before the MAX crashes in 2018 and 2019, for some 737 MAXs and 787s to issue final certifications. In other words, the ticket before it is handed over to the airlines or leasing companies. And this, in theory, should speed up final checks. The FAA says, look, we're confident that they can do this, and they've made the changes in terms of manufacturing processes. For the 737 MAX, the implications here are clear. They currently build at 38 per month. In the next couple of months, if the FAA says okay, they'll move up to 42 per month. Year to date, their deliveries are 285. As you take a look at shares of Boeing, keep in mind they are on track right now to surpass 2023, which I think was their all-time best year for 737 MAX deliveries. Also had a big order today from Turkish Airlines for 75 787s. All around, Courtney, a big day for Boeing.
Yeah, absolutely. Shares up more than 3.5% here going into the close. Thank you so much, Phil. I'm going to turn back to Mike Santoli. Mike, interesting here. We have most of the sectors higher here except for consumer staples. Earlier on in the day, I think energy was the leader. It's moved around. Then it was consumer discretionary, now utilities, but not that big tech name that we have seen so often with the AI trade and otherwise. And maybe spreading the wealth a little bit.
Yeah, absolutely, Court. And there is a kind of a best case scenario in terms of how the market deals with this little moment of fatigue or flattening out of the indexes, which is to allow the Mag 7 type stocks, the semis and the AI plays to cool off a little bit, have everything else take up the slack, whether it's laggards like energy getting their moment, or it's just in general maybe a broader set of financials and consumer cyclicals and things like that. That being said, it doesn't always, the choreography sometimes breaks down. So I do think that they'll try it. The market's tried to rotate around. You do have the NASDAQ 100 underperforming for the week. The equal weight S&P is actually flat. It's not even down on the week. So there has been a little bit of a kind of a pickup in the slack by the average stock. Don't know if that's the trend, but I do think that it shows you the market has just not had a huge across-the-board selling impulse, even though, as everybody will recite, valuations are at a high. We don't really know if we're sure about what the Fed's going to do. And there really is a debate as to whether the soft labor stats are going to translate into broader economic weakness. So far, everyone's comfortable with the data they're seeing. Recession risk looks low. Credit risk is very much contained at this point. So it feels as if you're a bear, you're not quite sure where to go. And that's why I think a lot of the conversation has been around, is the AI trade just jumped the shark? And is it a bubble? And do we have to start worrying about that? And this was the week where all of that argument broke wide, in my view.
And you talked about valuations being high, but you also note that, some froth has been skimmed in some areas, at least.
That's exactly what this market has tended to do. It gets a little bit frenzied in some pockets, like, the quantum stocks or the crypto asset treasury companies, or whatever it might be. Sometimes it's the robotics names and things like that. And they sort of retrace and they go down and they almost live in their own little world. I noticed this week Palantir has been on the defensive. That's been a moonshot stock. So all this stuff, again, it works in this kind of harmony if the rotation stays in gear. And, so far we have, and we're going to wait and see if the macro picture does clear up at all. Market doesn't seem too concerned, as it typically isn't, about a government shutdown. Maybe we'll have to live without that jobs number next week. Could complicate the picture, but maybe in that instance, no news is good enough.
Yeah, absolutely. Usually we do shake that off. But of course, if we're missing that jobs report, that's some key data for the markets and for the Fed. Mike Foley, thank you so much. We really appreciate you being here with us today on this Friday. That does it for the closing bell, with the averages closing higher. Dow Jones Industrial is higher by 0.7%. Let's send it over into Morgan and John in overtime.
Well, that's the end of regulation. Ronald McDonald House ringing the closing bell at the New York Stock Exchange. Harrow doing the honors at the NASDAQ. Stocks rebounding today from a 3-day slide. The Dow closing with a nearly 300-point gain today was the outperformer. 0.5% for the S&P 500. The NASDAQ up by 0.33%. Still, despite today's rebound, all the major averages closing lower for the week. The NASDAQ was the worst of the bunch, but still the loss is less than 1%. Energy, utilities, consumer discretionary, the best performing sectors today. Meanwhile, consumer staples finishing in the red, the only S&P sector to do so. And energy in general having a really good week. The XLE up 4 days in a row, having its best since the middle of June. And we are seeing a big move in metals too. Gold with another all-time high above 3,800 for the first time. Silver, platinum, both higher by more than 3%. And look at the weekly gains. Because silver's up 8% in a week, and platinum, a big move, 12% almost.
Shiny. Well, that's the scorecard on Wall Street, but winners stay late. Welcome to Closing Bell Overtime. I'm John Fort alongside Morgan Brennan, and we're navigating Washington's impact on your money, from chips to trucks, pharma to furniture. Stocks are making moves on the latest tariff news. We will explore those groups.
And shares of iron down today after a downgrade, but the stock is still up 600% from the market lows in early April, as that company is right in the middle of the AI data center build out. Also Bitcoin mining. Company's co-CEO will be here on set to discuss. But let's begin with the impact of the president's plans to get U.S. chip making on par with overseas manufacturers. Christina Partsinevelos is joining us now from the NASDAQ with more. Christina.
Hi, and I need to start with Intel because it's really extended its rally this week, up, 20%. And today's news is really the U.S. government is considering imposing a 100% tariff on imported chips that exceed what a fab produces domestically. So you import one, you got to make one here. And that's why you're seeing Intel closing 4% higher. And that's also why the world's third largest contract chip maker, Global Foundries, closed 8% higher, given it does have significant U.S. capacity and could benefit from this new policy. Taiwan Semi was down about 1%. 1%, though large fabless players like NVIDIA, Broadcom, Marvell would likely redirect more orders to TSMC's U.S. facilities in Arizona, so that could be a positive. Tower Semiconductor closing roughly, it turned in the green, so let's say it's flat. It's an Israeli specialty foundry that has 2 fabs in the U.S. and could potentially ramp up production for U.S. customers, as could analog chip makers like Analog Devices, Microchip, Texas Instruments, which is why Texas is up over or closed over 1% higher. But the problem is execution would be very complex. Most chips are imported embedded in finished systems like servers and laptops. And so this would force system manufacturers like Dell, Supermicro, HP to really track semiconductor origins across their entire supply chain, which could be seen as a logistical nightmare. All of those names closing in the red. Bottom line, expanding U.S. manufacturing or promising to do so appears like the way forward. John?
All right, Christina, thank you. Now let's get to the bond market. Yields holding steady as the latest read on inflation comes right in line with expectations. Rick Santelli joining us on that from Chicago. Rick.
Yes, in line with expectations, but still warm, sticky. And the markets are very aware of this. Look at the 2-year and the 10-year on one chart. And notice how the 10-year seems to be breaking away to the upside in yield. That's the component, in my opinion, that's reflecting 2.9 year-over-year core. These are sticky numbers, and those are some of the Fed's favorite inflation numbers. Add in personal income and spending had some horsepower, and that's pushing longer-term yields higher. But we had Michigan confidence slip from its mid-month read, and that might be affecting the 2-year in a bit of a different way because that has been focusing mostly on the Fed. And if you open the chart up, we had a 2-year auction this week. That chart reflects more of the old 2-year. The new 2-year, a little bit higher in basis points. It basically is coming off a 1-month high yield close. If you look at 10s, it's a more aggressive chart. Now, that's from September 1st. And you could see, just like today's chart, the right-hand side of that hasn't turned lower like the 2-year. It's still moving higher. And that's reflected in the 210 spread. As you see, that's a 12-hour chart, and it has been steepening. The reason I find that so important now is because it certainly seems as though the market has a two-way issue it has to deal with. The economy, some of the data is actually not so bad, even picking up when you look at income and spending. But inflation being sticky and questions of how deep the labor market trough may be is going to make the Fed's mission that much more complicated. Morgan, back to you.
All right, Rick Santelli, thank you. Now, it could be a wild weekend in Washington as negotiations continue to fund the government beyond Tuesday, so into fiscal 2026, and to avoid a government shutdown. Emily Wilkins joins us from Washington with the latest in what is maybe, can we call it horse trading, or maybe anticipation of horse trading? I'm not sure very much is getting done right now.
Not very much is getting done, Morgan, and that's kind of the problem. It has been a week since the Senate tried and failed to ensure that the government would remain funded at the end of this month. And at this point, we're no closer to avoiding a shutdown. In fact, we're probably further away. Both sides really digging in. Republicans, of course, looking to continue current government funding until November 21st. That would give them 7 weeks to hash out the details of funding the government for fiscal year 2026. And it's, the same thing that Democrats have voted for multiple times when they were in power. Speaker Mike Johnson even tweeted today that when Biden was president, Democrats insisted upon keeping the government open, pointing out that now under Trump, they're doing exactly the opposite in hopes that the damage will somehow be blamed on Republicans. But what Democrats see this as one of the only leverage points they're going to have to move their priorities. Top House Democrat Hakeem Jeffries doubled down today, saying that Dems are not going to back keeping the government open unless Republicans agree to expand health care benefits.
One of the reasons why our fight for the American people is so urgent right now is because over the next few weeks, tens of millions of Americans are going to get notices indicating their premiums, copays, and deductibles are increasing dramatically because of the Republican refusal to extend the tax credits.
The Senate returns Monday evening to try again to pass a stopgap. And guys, it's not clear at this point whether that is going to be successful. But at this point, we're not seeing any Democrats really seem to shift and say that they plan to back it. John?
All right. Emily Wilkins, thank you. Now, for more on what Wall Street should expect from a possible government shutdown, let's bring in Monica Guerra. She is head of U.S. policy at Morgan Stanley Wealth Management. Monica, the Democrats are trying to make the shutdown potentially about health care, relitigating the president's bill from the summer, literally. Who gets blamed for the shutdown, you think? And if government job cuts come along with it, who gets blamed for that? Does that matter for the markets?
I don't think that piece matters for markets when we're thinking about blame. The electorate on either side is going to point to the other guy, right? That's sort of the natural flow of things. What Democrats are balancing here is trying to have, this one piece of leverage, like was mentioned earlier, to move on some of these priorities, in light of the fact that the president also has the ability to actually cut budgets while the government is shut down. So there is a lot at risk. Now, I'm in Hawaii right now with clients, and while it's a world away from Wall Street, they're worried about this because they're one of those key economies that's really dependent on government contracts like the Department of Defense.
What about healthcare, since that is one of the topics that's being tossed around here in this shutdown talk? Are healthcare stocks perhaps affected by what does or doesn't happen in this fight?
Healthcare stocks are likely to be impacted for sure. OBBBA, with the Medicaid rollbacks, that sort of stake in the ground that the Democrats are putting into place, it could have negative impact if you get continued cuts there. If the president says, all right, we're going to shut down, this could be an area that he continues to focus. So there is a lot at risk for not just individuals, but also the Democratic Party. The other thing I just want to highlight, the reason why I mentioned the Department of Defense and healthcare, I think together is a good example of this, of industries that are very heavily reliant on those government contracts. And during times of full government shutdown, you can actually get a sell-off. So in our view, that's a generally attractive entry point, especially for areas where you think you might get a return to regular funding. So like a defense. Healthcare is a different story. That's a longer term risk.
I'm glad you just brought that up. And I guess technically it's the Department of War now. But the expectation is that at some point you're going to get the government funded. It's probably going to be continuing resolution or stopgap funding, at least in the near term. Does that present a risk when you start talking about investing in government contractors?
Stopgap funding is likely to come. It's just, what is the time period? And the longer you wait, the more risk is injected. For us, when we think historically, you have to look at the bond market volatility. There tends to be a knee-jerk response when there's shutdown risk, but then that tends to die down. Importantly, this is because you get the government essentially making whole not just the labor and jobs that have been put on pause, the ones that are considered, non-essential, as well as making those contractors whole. So from our view, you have to see through that noise. And typically what happens in the equity space is that markets do see through it. And on average, you see about markets rallying about 4.4% on the back end.
So if you have a Congress that is very focused now on trying to get a fiscal 2026 budget in place, or at least, stall a government shutdown or prevent a government shutdown here, what other legislation is now being stalled in the process?
Big one is the Clarity Act around stablecoin. That's something that I would say the financial services sector in particular is looking for additional guidance on. Right, we had the Genius Act passed, and stablecoin was on stablecoin legislation with the Clarity Act was on the docket, on the agenda. Now that's going to be pushed likely to 2026. So we're going to have to wait for more clarity in that space, right, within the new year.
Okay. Monica Guerra, thanks for joining us. Well, coming up on Overtime, we're looking at sectors affected by the president's latest tariff announcements. 100% tariff on some pharmaceuticals that could go into effect next week. What it means for companies, what it means for consumers.
And Oracle falling 8% this week. Of course, it's had a huge AI run. Are the markets reconsidering valuations or just coming up for air? Overtime's back in 2.
Hydro.
Welcome back to Overtime. Shares of PACCAR, one of the best performers in the S&P today. The truck maker potentially benefiting from a 25% tariff. President Trump says he'll put on heavy trucks made outside the U.S. The president also saying he'll impose a 50% tariff on imported kitchen cabinets and bathroom vanities effective Wednesday. Shares of American Woodmark and Master Brand see rising more than 6%. Both do the majority of their manufacturing in the U.S.
Yeah, this is an interesting one. I mean, heavy trucks, maybe ex-PACCAR, are many of them are final assembled in Mexico. So that's a dynamic, I think, to watch here on the trucking side. And then in terms of furniture, 30% on upholstered furniture. Another dynamic to watch, RH, last I checked, was trading lower, something like 3%. It finished down today. A lot of folks, I think, also don't realize that a name like Lowe's is one of the top importers within corporate America into this country. So when you start talking about things like vanities and other home goods, these are some of the names to continue to watch.
Yeah, and how much benefit is there for those who are manufacturing in the U.S.? How flexible are these supply chains? I guess we're going to see how the consumer responds.
Yeah, diversification of supply chains continues here, and incentivization perhaps to manufacture more in the U.S., which is actually what our next guest is going to talk about. President Trump announcing last night as well that he will impose a 100% tariff on pharmaceutical products entering the U.S. starting October 1st, unless they are building manufacturing plants here stateside. EU and Japan will be exempt from the 100%, with the U.S. honoring the 15% cap that was put into place under the current trade deals. The sector taking the news in stride today. See a lot of green right there on the screen with the big pharma names. Our next guest says the move could be a relief for investors who have been uncertain about the sector since the initial tariffs announcement on April 2nd. So Citi Research Managing Director Jeff Meacham joins us now. Jeff, great to have you on. The fact that we're seeing the stocks trade higher, is that because this is a best case scenario for the drug makers?
Well, thanks for having me, first of all. I wouldn't say it's a best case scenario, but it definitely is a bit of a de-risking event. We've been talking about, as you mentioned, tariffs on the pharma industry really since April. And every week or every other week, it seems like there's kind of a new proclamation about the pharma and the drug industry. And so it does feel like companies that have already invested, they're going to, that's going to build some goodwill. And those that haven't, I'd be surprised if a lot of companies haven't already built new plants here or expanded their existing plants. But here we are, though. So it does feel like a bit of a relief.
All right. So I guess in terms of, because so many pharma names have announced plans to create more manufacturing here in the U.S., who are the ones that we should be watching that perhaps haven't, that could now potentially make an investment and or see increases to prices for imported drugs?
I mean, we put out a list of all the companies that have made public proclamations, and it's the entire industry. I would say the other segment that we haven't talked about, the spec pharma and the generics industries, there may be lower margin, type of P&Ls. And I think a lot of the manufacturing may not be here in the U.S., but a lot of the big guys, though, big cap biotech and big cap pharma, that includes U.S. and European companies. There are, plans that are already in place, and I think they've been expanded over the past spring and summer. And so this shouldn't come as a surprise to any of the leadership teams.
It seems there's some difference, Jeff, between promises and real plans. I think back to Foxconn, 8 or so years ago, promising this big LCD plant in Wisconsin that really never happened. Is the lead time less for this pharma stuff? How likely is it that the things that companies promise to do now to avoid the stick actually turn into a full-grown carrot?
Yeah, no, it's a great question. And the funny thing is that a lot of companies have 5 or 10-year plans to grow CapEx and grow their manufacturing footprint. And that includes everything from, API, the active pharmaceutical ingredient, to, the fill finish, the final product. And so my guess is that since this has become a priority for President Trump, that companies just became more public with their plans, and maybe they accelerated their plans. And so it's hard to say what was in the works already versus sort of new net, investments. But either way, though, I think there's going to be he's going to want some sort of proof that this is actually happening. It's kind of hard to stop. It's kind of hard to fake that. So my suspicion is that you'll see a lot of new plants breaking ground if they haven't already, this year going into next.
We'll track it for sure. Jeff, thank you. Jeff Meacham from Citi.
Thank you.
Well, GDP numbers this week showing a stronger than expected economy, but is the market fearing economic weakness? Mike Santoli is going to look at the moves in cyclicals.
And Electronic Arts spiking late in the session on news that it could go private. We've got more on that potential deal when overtime continues. Welcome back. Shares of Electronic Arts spiking late in the session on a Wall Street Journal report that investors, including Silver Lake, are considering taking EA private in a $50 billion deal. Now, that could make it the largest leveraged buyout deal ever. Saudi Arabia's Public Investment Fund and Jared Kushner's Affinity Partners also potentially among those investors. You can see shares finished up 15% today.
It's in the game. Well, now senior markets commentator Mike Santoli joins us for a look at a softening cyclical sector. Mike.
Yeah, a couple of them, John. They did actually firm up today. This would be consumer discretionary as well as industrials. But you see they had this trend of at least keeping pace with the tech-driven S&P 500 for most of the last year. And now they've slipped below that. And it's a little bit of static in the story here. By the way, these are the equal-weighted versions of the consumer discretionary and consumer and industrial sector. Using that because the other consumer discretionary sector is just Amazon and Tesla for the most part. So you see it's a little bit of a complication to the story that, hey, the stock market is telling us that we might be in for an economic reacceleration. It could just be, obviously, a little bit of a cooling off. But it's something to keep an eye on today. Although, as I said, they did rally on that personal income and spending data this morning. Take a look here at where the strength within industrials has largely been coming from. The middle line here, the XLI, is the broad industrial sector, doing very well. But it's really ITA, that's aerospace and defense, that has been one of the huge upside drivers. Also names like Uber, which happen to be in transports, is actually the lagging piece of this. So I would argue it's a static economic picture you're getting from the sector work, which suggests to me that there's a bunch of themes, very discrete themes, that seem to be carrying the market, and the rest of it that are just more economically geared is kind of falling by the wayside.
If we go back to chart number one, I was looking over the length of it, trying to figure out if there was ever a time when that green line had gotten so far above the others, at least on the, and there wasn't. So
not for this
particular time span. But do you happen to know when the last time was that there was that kind of a?
I mean, see, in 2022, when we had a full-on bear market in the overall market, the cyclical sectors did suffer more, but also big tech suffered more. So I think this is the problem with the S&P 500. So there you have it. You see especially industrials have been the big outperformer. Consumer has been slower to come back over the longer period of time. So this is going back 5 years. And so it's industrials. And again, it's where is it industrials? It's in the aerospace and defense, plus now all the grid and kind of AI adjacent power names that are working.
Gotcha. Mike, thanks.
Yeah, secular growth stories, both of those. We'll see you later this hour. Mike Santoli, thank you. It's time now for a CNBC News Update with Mackenzie Sigalos. Mac.
Hey, Morgan. So President Trump told Ukrainian President Vladimir Zelensky that he was open to providing Ukraine with long-range missiles. That's according to the Wall Street Journal, which says President Trump wasn't opposed to the idea of Ukraine using the weapons to force Russian leader Vladimir Putin to make a peace deal, but didn't make any commitments. Now, earlier today, Axios reported Zelensky specifically requested Tomahawk missiles. The National Hurricane Center is monitoring a new storm brewing near Hurricane Umberto in the Atlantic. This storm, currently called AL94, could be influenced by Umberto because of a phenomenon called the Fujiwara effect, when two storms get close enough to each other to influence their track and strength. Current projections show the new storm could hit the Carolinas early next week. And the NFL is expanding its partnership with Brazil. The league announced a commitment to play a minimum of 3 regular season games in Rio beginning next season. Back to you, John.
All right. Mackenzie, thank you. Well, coming up, the market snapping a 3-week winning streak, and the hottest AI names pulled back the most. Are we seeing a reversal in that trade?
And speaking of hot stocks cooling off, Iron, it's up 500% in 6 months, but it's down today after a downgrade. The company's CEO is going to join us. That's coming up. Welcome back to Overtime. Gains across the board for the markets today. The Dow closing higher by 300 points. The S&P 500 and NASDAQ both up right around 0.5%. All those major averages had been down 3 days in a row before that. But that's not enough to wipe out the week's losses. The Dow lower, but only slightly. Bigger losses for the NASDAQ, down about 0.2%.
Yeah. Well, the tech retreat coming as the narrative on AI faces some questions. One example is Oracle. That stock was down for a fourth straight day. It closed the week 8% lower. Oklo is another example of the AI rethink. The nuclear stock has had a big run, but fell nearly 20% this week. Despite the recent weaknesses in AI names, our next guest cites the AI trade as a reason to stick with U.S. equities. Joining us now is HSBC Chief Investment Officer Jose Rasco. Jose, happy Friday. So I guess a big question perhaps on investors' minds is, why isn't this AI run like the dot-com run before? Yes, the internet was ultimately a big deal, but we had to go through this, cycle of doubt that actually took down quite a bit of the market.
Look, you're absolutely right, John. And as you can see by my hairline, I'm old enough to remember that. So I think if you look back in the 90s, I would equate the first gen of generative AI is sort of like putting the phone, the modem together with the computer. We're at that level. I think the next evolution of AI, where it's going, and if you look at all the things that are coming in terms of working with industry and working directly, doing joint ventures with clients and helping them become more productive, that really is the future of this trade from our perspective. It's not just an AI input trade. It's more about the broader tech sector and what is going on in the broader economy, and how does this create a broader market rally? That's really our perspective.
So I started the week with Jensen Huang and Sam Altman at NVIDIA headquarters announcing this huge investment of potentially up to $100 billion from NVIDIA into OpenAI, very much about the promise of the future, how this infrastructure investment would lead to all of these breakthroughs and discoveries. But is so much of that priced into so much of the market right now that there's not room for error that will correct dramatically if there's a hiccup?
Well, and you and I have been talking about this for a while. I think if you look at the market now, growth has exceeded value for quite a while, and this bull market from the early April to now has been led by growth. It's been led by the Mag 7 and led by tech, and we think we need to see that broaden out. So we think we're at the beginning of a recalibration of equities here, and given what could happen with the government shutdown next week, we think we'll see a bit of a recalibration in terms of growth value. The Mag 7 versus the forgotten 493. Don't forget, earnings for the Mag 7 are about to slow. Beginning in Q3 through the end of the fourth quarter next year, earnings are going to slow from 23 to 15% for the Mag 7. But it's the forgotten 493. That's where we need to focus. These are the companies that are going to benefit from Gen AI, the adoption of Gen AI, and the next level of that, as well as pretty straightforward comps that they should be able to beat. And I think that's where we're going to see the earnings explosion, which is from 4% in Q3 of this year to 15% in the fourth quarter of next year. So that's our bet, is the market rally broadens out from here.
How much does that bet also hinge on the economy remaining strong or resilient, or at least not tipping into a recession?
Yeah, that is one of the key elements, no question about it. But I think if you look at where we are, the Fed just began a new easing cycle, right? And our perspective is that we think they're going to ease 2 more times here in Q4, in October and December. And the market is sort of locked into that as well. If you look at the SEP, the Summary of Economic Projections from the FOMC meeting, that's what they told us, Morgan. They're going to ease twice more this year, probably. And the labor markets have cooled enough to allow them to do it. Now, remember, on the inflation side, the Fed is battling higher year-over-year inflation. If you look at the month-over-month numbers, far tamer than they were last year. That gives the Fed some room to ease. And we still have the secular deflation from tech that has not really kicked in yet. But the other thing that they need to take into account is the fact that that 2% symmetric rate they're looking for may be tougher to achieve. If you look at the FDI that we've received in this country from 2018 to now, we're number 1 in the world in terms of receiving dollars and receiving assets, right? That's tremendous, but too many dollars chasing the same goods. that it may be tougher to get inflation to where they want it, but I think they would be very happy with a number in the 2 to 2.5% range.
Yeah.
Look at third quarter growth, 3.9%, according to the Atlanta Fed.
Yeah. Well, and that sort of leads me to my next question for you, Jose, and that is, and we don't talk about it enough, but M2, money supply, what is that signaling right now?
Well, look, and if you look at the graph of money supply from, 1940s, 1950s to now, it was sort of a straight line looking similar to the S&P. If you look at what happened after 2020 and then after COVID, we've seen some real ramp ups in M2. And part of that is definitely the FDI that's come into the economy. So that foreign direct investment comes in the form of capital, which is great because it's going to help us create new jobs, create new factories, and all the wonderful things we're talking about. That's great for future growth. In the current environment, though, we have to realize that there are more dollars in circulation here, and that is going to result in some competition for the goods and services that are produced here. So, that 2% target, symmetric target, is a great idea, but you need to see that AI productivity and that tech deflation kick in to get anywhere clear near that, we think.
Okay, sounds good. Also sounds like that's part of the bull case for industrials, which have had a strong run. Jose Rasco, thank you.
Thank you. Have a great weekend.
You too. Up next, the CEO of Iron. This is a stock that's up sixfold in the last 6 months. Find out why he's shifting the company from being a Bitcoin miner to an AI cloud and infrastructure provider.
Plus, Nike is the big name on next week's earnings calendar. Coming up, we'll look at whether those results can help turn the struggling stock around and shed more light on the outlook for consumer spending. We'll be right back.
Foresight Fund Services.
Welcome back to Overtime. Investors keep loving shares of AppLovin. The stock's rallying after Piper Sandler raised its price target to from 500 to 740 a share. UBS raised its target from 540 to 810. Both firms citing the growth potential of AppLovin's coming AI-powered Axon Ads Manager platform. The stock has had a stellar year. It has more than doubled.
All right, well, turning to another high-flying stock, Iron. Shares are under pressure today, or they were, but up sixfold in 6 months. The company owns and operates huge data centers that are run on renewable energy. This is a huge growth area amid the quest for more AI compute capacity. Iron is also a miner of Bitcoin and other things that involve heavy-duty compute power. So joining us now, right here on set, is Dan Roberts, Iron co-CEO and co-founder. It's great to have you back on set.
Great to be here.
So let's start with that, because this has been the big talking point, and we've had a big week with lots of news and lots of AI deals announced. Where do you play in the space? How quickly is it growing?
Super quickly. We can't meet the demand fast enough. And at the heart of it is these AI factories that are delivering compute to hyperscalers, AI labs, inference, training, enterprise.
Yeah. So does this put you in competition with the CoreWeaves and Oracles of the world, or should we think about it differently?
Look, it's very similar. It's providing AI cloud compute to end customers. The key advantage we've got is we've got the data centers, we've got the power and land today. We are actively installing these GPUs every day at the moment to meet the demand.
It's interesting because we've been having these debates about, okay, maybe we're capacity constrained now, but a couple years down the road, does this swing from boom to bust? The cyclical nature, I guess, questions around possible cyclical nature around this. But what does that mean for Iron when you are vertically integrated and you do have these data centers that basically started as Bitcoin miners are now being adjusted?
Yeah, it's the same data center that was built for multi-purpose. So over the last 7 years, we have accumulated 3 gigawatts of powered land. Today, we've contracted for 23,000 GPUs that will deliver around 500 million in annualized revenue. That's less than 2% of our overall footprint. So big numbers. But as we discussed last time I was on the program, it's still a drop in the ocean compared to what is required over the coming years. One of the US investment banks forecasting a shortfall over the next 3 years of 44 gigawatts. McKinsey is forecasting an additional 100 gigawatts of data center capacity by 2030. They're big numbers.
How big are your advantages on power? I mean, you're located near some hydro, if I recall. So what kind of operating efficiencies does that give you?
So we've been 100% renewables since inception. Wind, solar, hydro. But the key distinction here is we don't take generation risk on renewables. That's the job of the utility. So we connect into these high voltage transmission networks. They guarantee us 24/7 reliable renewable energy.
So what happens in the medium term once, say, the hyperscalers get more of their capacity online? Is there a co-location play that you expect to happen for this AI infrastructure as well, or do they become more competitors of yours and compete on price?
Look, everyone's trying to do everything right now. If you speak to the hyperscalers, I think they're open to co-location, they're open to AI cloud. The reality is the industry just can't get enough capacity at the moment. So we did look at co-location, but as now we are focused on AI cloud. We are moving up in the value chain, capturing more of the economics by providing that compute and building relationships directly with end customers like AWS.
So are you all in then on AI right now, or are you still involved in Bitcoin mining and other types of heavy compute?
Look, Bitcoin was great. It bootstrapped the business. Today it's delivering about $1 billion of annualized revenue. So it's certainly not worth scoffing at, but the future is AI. As I mentioned, less than 2% of our power is capable of generating $500 million of annualized revenue. The outlook for growth in AI and servicing this market is super exciting.
How long does it take you to change over a facility from one use case to a different one, considering the equipment and the labor?
Look, we posted a video on Twitter this morning showing live time people swapping out racks of ASICs, which are used for Bitcoin mining, and just wheeling in the servers of NVIDIA racks. So as quickly as we can get the labor there, as quickly as we can get the chips there, we're installing them and making that capacity available.
So in terms of future sites, places that you're building, what should we be watching?
Well, look, as I said, we've got 3 gigawatts secured today, but we've also got a multi-gigawatt pipeline that we've also spent a large part of the 7 years building. So, look, the near-term growth is there, but also longer term, we're pretty excited.
Have you been surprised by the monster move in your stock this year?
Oh, look, it's been interesting, but I think when you look at the growth and you look at how quickly we can scale up this cloud business, we feel supported by investors. We've raised a lot of funding over the last few months, and I think they're recognising the scale of growth and how quickly we go.
Okay, Dan Roberts of Iron. Great to have you here on set.
Thanks, Morgan. Thanks, John.
Yeah. Well, still ahead, what's at stake for the markets and your money when the September jobs report is released next week? Plus, the other key events that need to be on your investment radar.
And check out shares of Intercontinental Hotels, which are surging after JP Morgan double upgraded the owner of the Holiday Inn and Kimpton brands to overweight from underweight, citing superior earnings visibility and defensive business model compared to its rivals, up almost 5%.